Hey everyone, welcome back. This is Ben Morales, your personal financial coach. And I wanted to make this video today because I've been having conversations with people that tell me that indeed they do want to pay off their mortgage. And I will say that paying off a mortgage it's a personal decision. It's something that people want to do, and it's a goal they set up for all different kind of reasons. Typically, if you have conventional wisdom will tell you if you have a low interest rate, you should not pay off your mortgage. You should go ahead and then take the difference and invest what you could potentially be investing to grow your assets and grow your wealth. That can be a strategy, yes, but if your goal is indeed to pay off a mortgage, one of the best ways to do it is using a line of credit, a home equity line of credit, and particularly to help more quickly and efficiently help you pay that mortgage down. So what I want to do is just want to give you a snapshot of recent conversation that I had with someone, and I want to give you just a profile backdrop on this particular client here. And so we can see they're like we always do on the channel, we cover their income, their expenses, their debt, and this debt happens to be the only debt that they have now. All the other debt we have pretty much eliminated. So it's a mortgage. That is the only debt that they have right now. So really good cash flow. Again, people who look at this on paper, they'll see that they have a mortgage at a 3.78, fantastic rate. They have a lot of cash flow. What are you going to do with it? That's the question. Well, if you're paying off your mortgage and you want to do it quickly and efficiently, you have to change the strategy than just sending an extra payment. Now, what I want to say is this purchase of the home was at 124,000 in 2016. Now, I'm going to put something up in the screen here. You're going to see something, right? According to calculator.net, you can see that the annual principal and the interest schedule is as such. What you're seeing right there is how much interest is paid off at the end of every year that they are in this loan at a 3.78 interest rate. Now, if you'll see and you notice, look at the balance at their 9 years. It's still $97,141. The only reason why you see a lower balance here on the screen is because they've been making extra payments here and there whenever they get a chance. And then another thing I want you to notice is that the crossover year doesn't happen to year 13. So that's still another 4 years away. And if you don't know what that is, a crossover is what year does actually more of the payment affect the principal than it does the interest. And you can see that doesn't happen until year 13. So we need to be able to change that because that is the slow way of doing things. And indeed, yes, it does have a low interest rate, but I just showed you the interest rate is not what you should just base your decision to pay off your home early and more quickly and efficiently off of. There is indeed another way, and that other way is utilizing a home equity line of credit. That's what we're going to show. We're going to implement the velocity banking strategy, and I want to show you how interest rate gets calculated on a daily basis when it comes to a line of credit. So now you saw the last screen that I put up that showed the mortgage. Here I want to show you another screen. And in this screen, you're going to be able to see how a HELOC is broken down. Now, just an FYI, this particular HELOC or this example is actually the HELOC that I have. So you can see there the interest rate. You also see the daily periodic rate. You also see the numbers there, 1, 12, 5. Those are the number of days that are being calculated at that particular interest rate. You'll see the balance, and then the final column, you'll also see the interest charge. And that is the amount of interest that's getting charged based upon the balances that are being maintained over the period of the month. There's 30 days in this particular month, and that's why you see it reflect that way. So now, I just want to give you an example. We're going to start this example on the month of April. And really why I want to do this is you can gauge more or less how much you will actually pay an interest rate, because interest on a home equity line of credit is calculated way more differently than it is on a mortgage. A mortgage is amortized. A line of credit is really calculated at the end of the day, and whatever your balance is at the end of the day, that's what you're going to be getting charged in interest. So using round numbers, I want to make this as simple as possible. And what we're going to work with is a line of credit that is in a first position, and the interest rate of the line of credit is going to be 7%. The line of credit that the amount that's going to be owed rather on it is going to be $100,000. Now, based on a line of credit at 7% with $100,000 that is owed on it, we know by using the calculation, right? 100,000 times 7%, you're going to get a number. You divide that number by 365 days that are in the year, and you're going to come out with a average rate of $19.18. That means that we will never pay more than $19.18 per day for owing $100,000 on a line of credit with an interest rate of 7%. So what does that look like? Well, let's break it down here. We're going to say that we are starting the month of April. The month of April coming up just a few days away, starts on a Tuesday. And we're going to see that for this example, from the 1st to the 3rd, $100,000 is owed on that line of credit. And you can see here, based on this, every day is costing us $19.18 to have the line of credit at that particular balance. So now, what does that look like at the end of the days that that balance is at $100,000? Well, if we take 1918, multiply that by 3, we know that in addition to the $100,000 that we started the month of April with on the 1st, we're also going to incur daily charges of 1918 over 3 days, which means that we're going to be charged $57.54 for this 3 days in April. We see that now at the end of that time frame, it's going to be owed $100,057.54 for those 3 days on $100,000. Now, what's going to happen is the very next day is a Friday. Well, this particular scenario, 4 payments, right, throughout the course of the month, 30 days, we divide their income by 4, and we're going to get $1,670.87. That is the amount of income that is going to be flowing into the line of credit, which is also going to be a payment that is going to be applied to the line of credit. And that's what we see here. On the 4th, this was the balance after that payment was made, $98,386.67. But because nothing else happened throughout the course of that particular day, it did cost $18.87 for that one day at the balance that remained as such, which means the new balance at the end of that day is $98,405.54. So remember, when you treat a line of credit like a checking account, which is what we're doing here because our money is being deposited into the line of credit, then you run your expenses or you take out money from your line of credit for your expenses. That's what's going to happen here. We're going to say that at the end of that day, $175 is going to be spent on the very next day, which is the 5th, right? So now we have to add basically the $175 that was purchased, right, to the old balance, which was $98,405.54. $175 is being added to that, and that $175 extra is going to be there for one day at that particular balance, which is going to cost $18.91. So when we go back to the other side, we know that that balance is going to be there for one day. And when you add the $98,580.54 to the $18.91, you come out with an end of day balance of $98,599.45. So hopefully you're starting to get the picture. You're starting to see how interest is being calculated throughout the course of the month. Remember, you don't pay bills every single day, right? You don't put gas in the car every single day. You don't go out to eat every single day. If you do, you should be careful there, right? But my point is that throughout the course of the month, money is going in and money is coming out. So we're going to see here that's what's happening on the 6th, right? We're going to experience another 6th is going to be a Sunday. Let's say they go to their place of worship and they give an offering at their place of worship. They go out to eat for lunch. So now another $100 is being spent on that particular day. That day is going to have a balance of it's going to be that balance is going to be there one day, or rather, and that's going to cost $18.93 for one day. When we add them up, the new end of day is 98,718 and 38 cents. So we can see what's happening here. Not always is the balance on the line of credit going to be the same. Then we're going to have another calculation here. We're going to pay on the 7th, where the new week is going to start, and what's going to happen on the 7th is going to pay $50 in gas. That's going to again affect the balance. It's going to bring it up to 98,768.38 cents, and that is going to remain there for the next 4 days. So those 4 days are going to be at that cost, at a total cost of $75.76, which means that when that's all calculated, just like you saw on the screen that I showed you, that's going to cost that's going to cause a new balance rather of 98,844.14. But the nice thing is, when you get paid, like we talked about, in this case, there's going to be 4 times that a payment is going to go into the line of credit, resulting on that line of credit to drop down in balance, resulting also in the amount of per day interest that is being charged. And that's what this is right here. On the 10th, there's another income that comes in, or rather on the 11th, there's income that's coming in once again. And what's happening there is it's dropping the balance, as you can see, 97,173.27. Now, what is the per day cost for those 5 days that it's going to be there? $18.64, or a total of $93.20, which when we go to the new end of day balance, right, for those 5 days, it's going to come at a cost of $97,266.47. So you can see, folks, here, the cash flow is the trick here. Cash flow is coming in, cash flow is being removed. Cash flow is coming in, cash flow is being removed. Every day, there's a different amount of interest that is being paid. Every day, at the end of the day, depending on how many days you're getting charged for that interest, the end of day balance is changing. And this is how you more quickly and efficiently pay a mortgage off. Again, if that is your goal, to pay off your mortgage, one of the best ways that you can do that is utilizing a home equity line of credit. Please don't focus on the interest rate, right? Everything has to do with where you're putting your money first, how you're using it, just like this. Put that money inside a home equity line of credit every time you get paid. And the second portion is how interest rates are being calculated. So at this particular speed, because this is speed, this is cash flow at its quickest thing, we can safely continue to rinse and repeat the process throughout the course of the month. And with this cash flow at a debt with only $94,000, you're looking at about 2.5 years that we completely eliminate this loan. And if you remember the first screen that I showed you, calculator.net, this loan, they had already been paying it for almost 9 years and only impacted $90,000. Well, in another 2.5 years, we could completely eliminate $94,000, be out of debt, and then go on to doing other things like investing or whatever it is that their sweethearts desire. So I hope this video helps you. Thank you so much for continuing to support the channel. Please put any comments and questions, concerns down. I will definitely get back to you just as soon as I can. And I thank you once again for tuning in today. Take care.